Oh, Microsoft's making waves today, and we've got two main stories to unravel for you tech enthusiasts. Buckle up. First up, Microsoft versus its peers. Everyone loves a good rivalry, right? Well, we're diving into a competitive analysis of how Microsoft is faring against other software industry titans. Microsoft's got its fingers in many pies, from Windows operating systems to the Xbox and Azure cloud services. But what does that mean financially? Despite some hiccups, like a 12.27% revenue growth rate that's actually less than the industry average, Microsoft's still been showing strong profitability metrics. Their price-to-earnings ratio and price-to-book ratios suggest their stock is a good catch on these fronts. Translation, it might be undervalued when compared to the industry's big fish. However, the price-to-sales ratio is on the higher side, implying that its stock price based on sales performance is a tad expensive. In simpler terms, while Microsoft shines in some areas, it's got gaps when it comes to sales growth, which should make investors think twice. Those balance sheet curves are looking a bit like a sine wave right now, amigos. And speaking of sine waves morphing into flatlines, let's talk about why Microsoft's stock is taking a bit of a nosedive. The trigger? Earnings report blues and soaring AI expenses. Yep, Microsoft posted a fiscal second quarter earnings report, and while it topped Wall Street predictions, shareholders weren't feeling inspired. Cue the chorus. Why isn't Microsoft's AI spending printing more money for us? The tech giant did manage to drum up $13 billion in AI-related revenue, marking a 175% surge from the previous year. Impressive, right? Not so much when you consider their mammoth $261 billion total revenue. Even with AI's thrilling expansion courtesy of Microsoft's cloud and AI services wowing investors, the cost of ramping up data centers and capital expenditures has more than doubled, creating some unexpected turbulence on the profit flight path. In comparing growth, Meta Platforms disclosed Q4 earnings growth of a stunning 50%. Microsoft's grappling with a more modest 10%, not painting the rosiest of pictures for enthusiasts of future gains. To sum it up, it's hard to woo the investors when sprawling investments don't swiftly inflate earnings. Microsoft needs to play the long game, proving its capital czar title by refining how it converts those eye-watering AI spendings into tangible windfalls. That about does it for Microsoft today, folks. Whether you're rooting for it, skeptical about the spendathon in AI, or just here for the drama, one thing's for sure, Microsoft knows how to keep techies glued. Until the next swipe or scroll, stay savvy. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.